Our long-standing case in Bitcoin, one that we've obsessed about for quite some time on AUGERE, now needs some revision. First and foremost, and as anyone knows who's followed this channel for some time now, we don't do raw TA, especially not when it comes to Bitcoin and crypto. No, we build cases, and that's why we land on our feet whilst most others crash and burn. So what then is raw TA, and moreover, what exactly is a case? Raw TA is simply to look at the underlying but without any context whatsoever, neither internal nor external. Building a case, on the other hand, is to contextualize things, to add on new and relevant and independent technicals and to revoke obsolete ones. But most importantly, it is to connect the interconnected. In the case of Bitcoin, we therefore add the strongest relevant technicals together in a constant flux. But even more so, it's about comparing Bitcoin to mining companies and altcoins. And by doing so, we acquire a far more superior and holistic view in terms of risk and reward than could otherwise be attained. In this sense, a case versus brute TA is like 3 dimensions versus 2. And this continuous building of cases is particularly of value to us at this very moment, and is precisely what we'll discuss in today's episode and why. But first, not financial advice, not a single word of what I say. And if this episode better helps you appreciate the current strength level in Bitcoin and what dangers to stay away from, then please return the favor by hitting the like and subscribe buttons. Despite the fact that these short episodes are rather simple, they still take a good chunk of time to produce. Your clicking certainly helps. Thank you. And if you want to join in on the continuous fun on AUGERE, then please sign up with the link in the description below. Let's now delve into the case. Lately on AUGERE and also here on YouTube and on Twitter, we've talked about how Bitcoin was preparing for a buy setup based on 3 individual technical criteria. First and foremost, we had the symmetrical triangle in the RSI on the daily chart in Bitcoin, in which we recently broke out to the upside. This alone was never a buy signal, but rather a premature notification of upwards power to follow. A turbo, if you may. Secondly, and the key aspect in this entire case, we had an ascending triangle in Bitcoin. Naturally, this would never break out unless the RSI were to break out first. Now we've had that triangle breakout, and thus 2 of our 3 points are nicely checked. Now this leaves us with the third and final one, the black sheep in this case equation, namely Marathon. Whilst Bitcoin took off by 10% or so during the weekend, I did, truth to be told, expect a proportionate reaction in Marathon too, a blast through the horizontal resistance. Yet on Monday we saw anything but the like. Initially, the stock made a futile attempt at breaking above, but it didn't take too long before it was back again in its cursed channel. And this is where things get truly interesting and relevant, for this is where our case begins. For as most inexperienced traders will base their entire position on the triangle breakout in Bitcoin, we know that such move will be limited unless Marathon follows suit. For as long as Marathon is stuck in his range, there's no way in hell Bitcoin will proceed up with free rein. For when Bitcoin runs on the fairly rare occasions when it trends strongly and persistently, that's when Marathon has its time to grossly outperform that of Bitcoin's spot price. But by instead staying pat in its range and thus showing immense weakness and hesitation, it naturally follows that Bitcoin's going nowhere. Had Marathon broken out to the upside on Monday, however, it'd be a completely different story. Instead though, its start of the week disengagement caused me to take another look at Bitcoin to revise our case. And what I found was this, a diagonal resistance line that perfectly fits the Marathon bill. And if we expand on this diagonal line, we quickly notice how it in fact amounts to a diagonal channel, or a bear flag if you may. Now, bear flag or not, it doesn't automatically mean it'll break out to the downside. We still have several checkmate technical arguments for this area being a reversal point. And in this case, we're talking strong ones like the lower bullish red signals and the ABCDE triangle that is still fully in play. In this sense, I am still bullishly optimistic. But be that as it may, we still don't take longs at technical resistance. It's just too risky, and that's trading 101. Going long here is far more dangerous than doing so here, once the price has broken out to the upside. Now, the ideal scenario for now would be for Bitcoin and Marathon to consolidate right below their respective technical resistances. In Bitcoin, it looks something like this, and in Marathon, it looks something like this. For as counterintuitive as it may sound, such price action has a predominant bias to result in long-lasting and strong moves to the upside, if or when they manage to break out. And naturally to the downside if or when it were to consolidate at support. The beautiful thing right now is how Marathon is seemingly establishing a diamond formation, and this one we can identify on the 1-hour chart. Now, these are rather rare, but the technical nature of these is that they have a bias in the direction of their prevailing trends. In this case, the trend is up, and hence the expected breakout is most likely to take place to the upside. But diamond or not, some nicely collected price action below the resistance is good enough. With that said, if we can get breakouts in Bitcoin and Marathon, then chances are we're in for quite a ride, but no break, no take. On a final note, this is precisely why our case approaches are of such high value. For had it not been for Marathon's utter failure to follow suit, then we'd be stuck in a potentially fast waning high-risk breakout in Bitcoin. Now, on the other hand, by updating and adapting our case to the new interconnected data, we can stay out of the way and rather target a low-risk breakout rather than being stuck in high-risk volatility.